All right, everyone, well, welcome to today's video. I'm really excited to share with you the personal strategy that I've been using to trade in the currency markets using macroeconomic fundamentals. Now, this video is for anyone who's been trading the currency markets, maybe using technical analysis, finding there's a lot of inconsistencies in your trading, maybe you've been losing quite a lot, and you've really got to a stage where you're wondering, like, what is it that really drives the value of currencies? And if you're new to Forex trading, this video is going to help you avoid a lot of pain and basically following, unfortunately, what most retail traders go down the path of understanding is currency trading, which is using price action, technical analysis. And this is going to open your mind to a whole new way of trading and investing, okay? I've made a ton of money using the exact same strategy, which I am going to show you in this video. And I've taught this to hundreds of people all around the world, and the results will speak for themselves, okay? So what we need to understand, number one, is when it comes to currency trading, the professionals are always talking a language which the retail community are not talking about, okay? What you'll see is, and listen to the synchronicity between the headlines you see on Bloomberg, hedge funds turn bearish on the Kiwi, which means they're selling the the New Zealand dollar, as another large Reserve Bank of New Zealand interest rate cut is seen. Notice how they mention one thing. Economists see the RBNZ cutting interest rates in February. Interest rates is what they're talking about. Asset managers most bullish on the Japanese yen since 2021 of Bank of Japan hike bets. Bank of Japan interest rate hike bets. The yen's rally gains steam with global carry trades in the balance. Carry trades is the strategy which hedge funds use to profit from interest rates. Hedge funds turn bullish on the yen after carry trade blow up. Again, notice how hedge funds are buying the Japanese yen because of the carry trade, all down to interest rates. Okay, hedge funds beat a hasty retreat on bets against the yen as the once beloved carry trade crumbles. Okay, sorry, I've got my camera behind the screen there. So here you see a flow of news headlines talking about something very different to what most people are taught how to trade. They're all talking about one thing. The hedge fund community, the professional traders are focusing on interest rates. This is their strategy. When I first learned the strategy, it opened up a whole new world to trading currencies, which I had never known because unfortunately when I first got into trading, I was learning from other retail traders and I wasn't focused on where the professionals are putting their money. Okay, notice how the headlines never speak about hedge funds moving money because of charts and patterns and trend lines. There's always a fundamental reason why an exchange rate is going to go in favor of one currency against another. And the number one reason is always interest rates. Okay, now the reason behind that and why it's so important for you to quickly grasp what I'm saying is because you have to understand that central banks and interest rates are being used for one simple reason. The government mandates the central bank to make sure that there is economic growth. So the central bank is going to use interest rates to ensure that there is job creation in the economy, which allows citizens to increase their incomes, which allows consumer spending, okay, which then allows businesses to invest in more production, okay, and hire new people so everyone has a job. People then become more wealthier, okay, because businesses are selling more goods and services. Maybe the shares of companies are going up in the stock market. Your pension could be in the stock market, or your investments, or maybe you buy a property. And because people are having jobs and spending money and there's income and there's wealth expansion, asset prices are going up. And this is how they maintain a growing economy, wealth expansion. And this is what is the key driver for inflation and economic growth. So central banks are using interest rates, the money supply, to maintain economic growth, to make sure everybody has a job, or try to make sure everyone has a job, okay? So there's maximum employment and there's wealth creation inside of an economy, okay? And what you need to understand is the central bank and the governments work together to make sure that there is inflation, because if there's inflation, that means people are spending money, creating the good demand for goods and services to go up, meaning prices rise because businesses can raise prices to make a profit, and they raise prices because they have to invest to meet that demand, and it makes production more expensive. But inflation and economic growth go hand in hand. So if you have inflation, you have economic growth, and that's a positive. Okay. Now, again, the reason why central banks need to create inflation around a specific target, so in most economies it's 2%, is because in order for you to create economic growth, consumers and businesses need to spend money. That's all you need to understand. And the central bank and the government are the guardians of the financial system. And the central bank's job is to use monetary policy, which is interest rates and the money supply, to create inflation, as I said, and help maximum employment to ensure they have consistent economic growth. And monetary policy, which basically means central banks controlling the money supply by using interest rates, is how they stabilize inflation around their target. Let's call it 2%. Okay? So central banks and governments work together. This helps to drive inflation and interest rates. And it's interest rates, which is what is driving the value of currencies, because interest rates are being used to ensure inflation continues to go higher. Okay, or remain around their target. Okay, so once you quickly understand that the hedge funds are using interest rates as their main strategy, interest rates can become your best friend, and you can make consistent profits if you're trying to invest in the currency markets. Okay, now how do I know this is true? Before I go into this whole entire strategy, all I want you to do is simply listen to someone who took my education and the results they got for themselves. Just a 1-minute video, but just pay attention.
Hey, what's up? This is a video testimonial for my man Kyan's Markets. Bought Kyan's course about a year ago, and immediately learning the fundamental reasons why one currency moves against another, the global economic factors that will contribute to the strength or weakness of a currency, was really enlightening, and the value that I've gained from the course is tenfold over other courses that I've paid a lot more money for that were just a bunch of back testing garbage that really didn't teach you any fundamental reason why one currency would move over another at any given time. Started an account at the beginning of the year with $5,000, started trading live, turned that into $25,000 so far, and have some nice goals here before the end of the year, and I'm continuing to go back over the course, and every time I do, I learn something new.
So there you go. What I'm about to show you, I've proven with many testimonials, with my own training, with my own community, exactly what I'm going to show you has helped some people turn 5K to 25K. So you'll get exactly the same results. Okay, so if we're going to break down what this is, what we have to understand, central banks have a mandate to make sure inflation stays around 2%. Okay, why is it important to make sure that there's inflation and not deflation? Well, if there's inflation, there is high consumer confidence, which is why people are spending, because they're confident about the future. Okay, so consumers are spending, which increases incomes, which means businesses then start to try to increase production to meet the spending of consumers. So they hire more people, okay? And then again, there's more increased spending because more people have a job. You have higher inflation. They try to keep it around their target of 2%. And then you get economic growth, which is their target. However, on the other hand, central banks do not want deflation. They don't want low consumer confidence, because then consumers will cut back on spending, which will mean there's decrease in incomes, there's less business production, so there's lower employment and higher unemployment. Then there's even more decreased spending. Inflation falls because the demand for goods and services are going down, and then you have lower economic growth. This is the problem the central bank is always trying to avoid. Okay, and this is where you have mass levels of unemployment and poverty. So the central bank and the governments, as I was saying, they're working together to ensure economic growth. Okay, and they do this through interest rates. So central banks control inflation using interest rates and the money supply. Now, consumer spending and business production is driven by access to capital via loans or cash that people can spend. Now, central banks can control your spending by increasing or decreasing interest payments. Now, I'm not a conspiracy theorist, but maybe there's a reason why you don't learn about finances in school, because if everybody gets into debt with a mortgage, credit cards, car loans, student debt, personal loans, business loans, It's very easy to control your spending to make sure that the purchasing power of paper money can be controlled through interest rates by the government, by the central bank. So when a central bank is raising interest rates, this can control inflation and make sure it comes back down to target, because if millions of people at the same time see their interest payments going up across the board, what they're going to do? Cut back on spending because they have less available income. Okay. On the flip side, if central banks want to get economic growth moving again, they could cut interest rates, which means your mortgages, credit cards, car loans, student debt, personal loans, business loans, these all go down. There's more money to spend. It can pick up economic growth. And later on in the course, I'll show you how as these interest rate changes, which is why the hedge fund community and all the big investors are buying and selling exchange rates. Okay, so interest rates are key to the value of a country's currency. Okay, because the value of a country's currency is being eroded by inflation, so they need to keep it around a specific target. But inflation is good for economic growth. Okay, so let's look again into what the central bank, how they control inflation using the money supply and interest rates. So when central banks are raising or lowering interest rates, there's something in the Forex market called the overnight carry trade. Okay, and this is what all the hedge funds are making their profits from. Okay, Bank of England sparks hedge funds' biggest bearish sterling bet reversal. Basically saying hedge funds have bet now on the pound because of the Bank of England. Hedge fund boost dollar shorts. Bets on slower Fed hikes. Federal Reserve interest rate hikes are now slowing down. So hedge funds are buying the dollar. Okay, yen breaches 150 psychological. Inflation fuels Bank of Japan bets. Interest rate increases. Okay, there's so many different articles here. It just all says the same thing. Hedge funds pivot to selling the euro against the yen on Japan rate bets. Japan interest rate bets. So you're going to see this, guys. This is the language that professional traders are using. Okay, and what we need to understand is whenever we're taking a trade in the currency markets, there is a funding currency and there is an investment currency. Because let's say I'm trading Euro USD. If I want to buy the euro against the dollar, I have to sell the dollar to buy the euro. Okay. If I want to sell Euro USD, I have to sell the euro and buy the dollar. So whenever you're taking a trade in the currency markets, money is being exchanged from one currency into another currency. And the interest rate set by a country's central bank means that the trade that you're taking is either going to be an asset for you or a liability. Okay, because what we always have to understand, okay, that when you're taking a trade in the currency markets, if one currency has a higher interest rate than another country's currency, and you take the trade where you're buying the currency with a higher interest rate, you're earning free money every day into your trading account. It's called the overnight carry. It's the difference in interest rates, which is why you keep hearing when I was showing you in the headlines about the carry trade. It's all down to interest rates. And on the flip side, if I was to actually sell, for an example, the dollar against the euro, so I'm selling dollars to buy euros, if the US actually had a higher interest rate than Europe, I'm losing money every day I hold that trade open. Okay, because the currency that I'm selling actually has a higher interest rate than the currency I'm buying. So what we need to look at is this. Whenever you're exchanging an exchange rate, okay, you're trading, the currency you're buying has to have a higher interest rate than the currency you're selling, because if it is, you're making money. And this is why the hedge funds are constantly pulling billions of dollars towards an exchange rate where they can sell one currency and buy another currency and get free interest. Don't worry, I'm going to break this down and show you specifically how this works with position sizes, okay? And they're trying to always avoid taking a trade where you're selling one currency to buy another currency, but the currency you're selling actually has a higher interest rate, okay? And this means you're losing money. So an exchange rate is an opportunity for you to sell a currency to buy another currency. And the currency you're selling, this is a liability because you have to pay interest on this currency. And the currency you're buying, you need to view this currency as an asset, but the asset has to pay more interest than the one you're selling, okay? Once I get through this, it will be an aha moment in your mind. Okay, so let's look at an example. The Australian dollar went up in value against the US dollar by 75%, okay, from 2009 to 2012. okay, the Bank of Australia aggressively raised interest rates, okay, at a time after 2008 financial crash, but the US central bank kept interest rates at zero, okay? Now, what do you think that means for investors? If you're an investor and you could sell your US dollars to buy Aussie dollars and get more interest on the Aussie dollars you purchase, there's a flow of money going from the US dollar into the Australian dollar. And on the flip side, if you're an investor who invests in bonds and Australian government bonds are paying more interest than US government bonds, then all the pension funds, the insurance companies, they're selling US dollars to buy Australian Aussie dollars to park their money in the Australian government bond market to get all this extra interest getting paid. And it causes huge moves in the currency markets, okay? So let's take a look at some examples and I'll break it down for you. All right, so let's go and look at the Aussie dollar against the US dollar between 2012 to 2015. Now, this is a perfect example of interest rates. And I'm going to show you on a beautiful spreadsheet how this actually works. So notice the Aussie dollar went up in value against the US dollar between 2009 and 2012 by 75%. That's a huge move in the currency markets, okay? And what I want to show you, okay, so let's look at the difference in interest rates between these two countries, okay? If we look at 2009, let's just zoom in a bit. If we look between 2009, the interest rate in the United States, okay, when did the trend start to happen? In early 09, around February. So let's just go back over here. Let's have a look. Let's go to February 09 when the trend just started. Notice that the United States interest rate was 0.2%. Australia's interest rate was 3.3%. So there was a difference, okay, between the two countries of 3% in Australia's favor, okay? Now, what that means is if you're a currency trader, and let's say you're taking a trade in the Forex markets. Now, this is where the overnight carry trade comes into play, which I'm going to break down for you, and it will make a lot more sense when you understand how this all plays out in real time. Okay, so this is called the overnight carry trade. Let's say this is Australia, and this is the United States dollar. Australia's interest rate was 3.35%, and the US central bank's interest rate was 0.22%. Now, this is the overnight carry trade I'm talking to you guys about. So, if I'm trading lot sizes, which is like a position size that I take in the currency markets, even if you're new to trading, you don't understand this, it will make sense. Okay? If you're trading, you already know our lot sizes, and maybe you didn't understand how interest rates really work. For me to sell the US dollar to buy the Australian dollar, I only get charged 0.22% interest on the dollars that I borrow and I sell in exchange to buy the Aussie dollar. But I get paid 3.3% interest on the amount of Aussie dollars that I buy, okay? Which means there's a difference of 3.3%. So if I'm a hedge fund, and let's say I'm trading a position of 1,000 lots, that means each and every day I could be earning $90,000 in profit, in free money being credited every day I hold the trade open because of this higher interest rate. And look what happens when on this interest rate hiking increase. So between 2009 to then, when does the trend come to an end? 2012. By 2012, look at the interest rate difference. It's gone from 3.3% to now 4.17%, okay? Or you could look at late 2011, it goes up to its peak at around 4.68%. So remember I just showed you the free interest that hedge funds are earning off this trade? When this interest rate differential goes up, when Australia's central bank goes to 4.75%, now look at the difference. Now hedge funds are making 130 grand a day in free interest, okay? So think about that. What do you think the investment community between hedge funds are thinking when they already know, and this is how I'm going to teach you about interest rates, they track economic data, which is predicting inflation and predicting interest rates, which is what we're going to go on to next. How do you predict this? And that's when they start to take these currency trades. Because think about it, if you're earning 90 grand a day and then you're expecting quite a few interest rate increases by a central bank, what do you think all the hedge funds are doing? They're thinking, hold on, I could be earning 130 grand a day. So as a central bank in Australia is raising interest rates, and it's becoming more and more attractive for investors to simply just sell Aussie dollars, US dollars, and buy, sell US dollars and buy Aussie dollars, you get a trend that goes up 75% in Australia's favor. That's a big move, okay? And then notice, the trend ends towards the end of 2011, coming into 2012. Why does the trend end in 2012? Well, you've already seen, because interest rates in Australia hit their peak, okay? And then going into 2012, interest rates start to come down. So the central bank in Australia starts to cut interest rates from 4.75%. It starts to go down to 4.25%, down to 3%. So Australia's central bank starts to cut interest rates. And notice what happens. Between 2012 and let's call it 2015, the interest rate difference goes from being 4% in Australia's favor to now 2% in Australia's favor. And no surprise, what happens? The trend, which was going up 75% in the Australian dollar's favor, now it reverses. And the exchange rate for the next 2 years goes down by 40%. Why is that? Well, if you're a hedge fund and you've been earning all this free interest into your trading account and you caught the huge move in the exchange rate, let's say you've locked in a 75% move in this exchange rate, you've made a huge fucking return on your money, right? What is the thing that you don't want to do? You don't want to be caught on the wrong side of the trade, and as all the other hedge funds are exiting, because if you're a hedge fund, you've made 75%, and this is the key to trading currencies, an exchange rate will keep marching higher for as long as the central bank keeps raising interest rates. And as soon as that interest rate difference hits a peak and it's no longer going up anymore, boom, the exchange rate hits a ceiling. Okay? And if a central bank in the United States either starts to raise interest rates or the Australian central bank starts to cut interest rates, that free interest, that $130,000 a day, is now going to start to go down. And investors are going to run for the hills, lock in profits, get out the trade. And the hedge funds at the same time unwind the trade quickly because they don't want to be the one who makes 75% and then next minute they don't close a trade and they've now only have a 40% return on their money. Remember, you're a big billion-dollar fund, you're trying to hold that profit because that could be hundreds of millions you're trying to protect. Okay, so that explains it. The overnight carry trade is the hedge fund community trying to ensure that when they're getting paid all this free interest and they're catching this huge move, they're going to get out the trade the moment that interest rate differential is now going against them. Okay, because again, you don't want that interest rate, you don't want that difference to start to narrow against you. Okay, you want to lock in your profits. All right, so the page I was just showing you, where are we? So the page I was just showing you here, they are now, when interest rates start to go down to 2.25%, notice how much their profits go down. Look, 130K. You don't want to be the one only earning 60K a day. But remember, if you're a hedge fund, now this is the key to remember. If you're a hedge fund, let's say you got into the trade quite late. Let's say you bought around here, right? Now, if the exchange rate doesn't move by a single inch, you're going to be making this free interest each and every day, right? Which equals up to 1.98% over 365 days. Because remember, an interest rate is an annual interest rate. But if the currency pair goes down by more than 2.25% a day, let's say the currency pair goes down by 20, 30%, and you're caught on the wrong side of the trade, you bought when the exchange rate started to go lower, well, it doesn't matter if you're earning free interest, you're actually losing more on the trade. So this is why hedge funds are trying to get out the trade, because some of the hedge funds may have got into the party a bit too late, okay? And they're trying to get out of the position. All right, so now you can understand why interest rates can really cause huge moves in the currency markets. I'll show you another example. The Federal Reserve started to raise interest rates in the United States, okay, in 2022 because of COVID and the war in Ukraine drive energy prices up. You guys know what happened. Inflation went through the roof, okay? But again, let's look at what happened. Notice that as a central bank was raising interest rates, the Bank of Japan, the whole entire time, wasn't raising interest rates. And the reason was because the Bank of Japan didn't have an inflation problem. As I'm sure many of you are aware, Japan has had a deflation problem for a very, very long time. So this is our macro spreadsheet, which when I come onto the into the macroeconomic data we follow to predict these interest rates is going to get interesting. But let's have a look. Back in 2022, when the Fed was raising rates, where was Japan's inflation? It had only just started to rise. Because look, before COVID and before the hyperinflation that came, look at Japan's inflation the whole entire time. Very low, not even at 2%. So inflation in Japan has been very low for a very long time, for 30 years after their stock market crashed in 1989. So the Bank of Japan had interest rates around 0%. They've had 0% interest rates for over 30 years. They've had to try to keep it low to get people spending, to try to get inflation up. So when the Federal Reserve started raising rates, and I can show you right over here, so you will see, if we come over here, the Federal Reserve started raising rates in March 2022. Now think again from the hedge fund's point of view. Now you see how we looked at those carry trades in the headlines. It said the beloved carry trade blew up in the earlier slides. This is exactly what happened. So look, the Federal Reserve started raising rates, okay, in March 2022, right? The Fed started having to raise rates aggressively. The interest rate in America went from 0.25% all the way up to 5.5%. Now look, the other side of the carry trade, remember I told you about bond investors, pension funds, insurance companies. So here is the interest rate on a 10-year government bond yield, which is the most freely liquid and highly traded government security in America. And this interest rate follows the central bank's interest rate. So notice, as the interest rates in America start to go up from March, interest rates on government bonds are going up, and look at USD JPY at exactly the same time. So the exchange rate is rising because interest rates in America are going up. Notice, as soon as the interest rates start to decline a bit, the dollar-yen exchange rate falls. Soon as the interest rate starts to rise again, dollar-yen takes off again. You have a period where the interest rate on government bonds start to decline again, dollar-yen declines again. Then you have a situation here where the bond market takes off and starts to rise. So interest rate in government bonds in America are going up even more. Okay, so the exchange rate takes off. Okay, and then you see a pullback here in interest rate in government bonds, dollar-yen. Up again, dollar-yen, because interest rates are going up again on government bonds. So what you need to remember, again, the bond market, trillions of dollars are flowing around the bond market based on whoever has the highest interest rate. Okay, and for an example, if you're a Japanese investor, number one, Japan has interest rates at that time very low. So when the Federal Reserve starts raising interest rates in the United States, look where rates were in Japan at the time. 0.1%. So think about it. You're an investor. You're seeing interest rates in America going up, and you're a pension provider. You're a normal investor. Why would you buy Japanese government bonds that pay 0.16% when you're seeing interest rates in America go up to 4%, 5%? So Japanese investors are selling Japanese yen, buying US dollars, going into the bond market and buying US assets to earn that overnight carry, that interest. And then you have the currency traders at the same time doing exactly what I just explained to you with the overnight carry trade. They're looking at that trade and they're thinking to themselves, fuck me, that is the greatest trade in the world. The whole investment community is seeing it because interest rates in America go from 0.25% And at the time, interest rates in Japan, the central bank's interest rates were 0.1%. So imagine if I sell the yen to buy the dollar, I'm earning around 10K a day. But look what happens as the Fed rapidly raises rates. So maybe the Fed goes to 0.5%. Now I'm making 17K a day. Then the Fed goes up to 1% because they try to catch up to inflation aggressively. This is what the Fed was doing with the interest rate. When we go back and we have a look, okay, then it goes to 2%. But look how much you're making every day, how much it goes up if you're a hedge fund. Now you're making 60K a day. Then the Fed goes to 3%, 90K a day, 4%, 118K a day, 5%, you can make 150K a day. The Fed's interest rate peaks at 5.5%. This is why when I was showing you over here on the slides about the yen's rally gain steam with global carry trades in the balance, okay, after the carry trade blow up. So basically what these news headlines were showing you is that hedge funds, just like the Aussie dollar, US dollar example, was chasing all this profit, okay? Dollar yen screaming higher. The dollar gains its value against the yen by around 50%. But the moment interest rates come to a peak, boom. In October 2023, right guys? When did the Federal Reserve stop raising interest rates? When did they hit 5.5%? July 2023. Notice, guys, the bond market hits a peak and the exchange rate hits its peak. It doesn't go any higher because the bond markets have peaked because the central bank's interest rate has peaked. Exactly the same as I was showing you with the Aussie dollar, US dollar example. And then what happens? Notice, guys, what does the Federal Reserve start doing? Last year, cutting interest rates. 5.5%, 5%, 4.75%, 4.5%, where we are now. No surprise, exactly the same thing happened as the Aussie dollar, US dollar. The US dollar since then has lost 12% of its value because hedge funds are now getting out the trade to lock in their profits, okay? Because the interest rate differential has changed between the two countries. All right. So this is so crucial for you guys to understand. If we go back to the Aussie dollar, US dollar example, and we go back to that exact trend we was looking at back here in 2012 to 2008 to 2012. So 2009, 2012, that same trend I was just showing you. Notice again, why was the bond market also attracting so much money? Because look, Australia's interest rate, and notice how the exchange rate is doing exactly the same thing. As interest rates in Australia are rising rapidly, so is the exchange rate. And no surprise, as interest rates in Australia went from 3.5% or 3.8%, look on the right-hand side, guys, and it peaked at 5%. Notice when it peaked at 5% and didn't go any higher, exactly the same as I showed you for the US dollar JPY, the exchange rate peaks, boom, it's done. And notice when Australia's central bank between 2012 and 2015 started to cut interest rates and the interest rates and government bonds started to go down, look what happens with the exchange rate, slumps. Again, why? Because investors are trying to earn interest. And if Australia's central bank is cutting interest rates, what investors going to do? They're going to try to find somewhere else to park their money so they can earn that interest. This is why interest rates is the #1 reason, guys, why currencies go up or down in value. Now you're seeing the trends. It's all about who has a higher interest rate because the bond market is going to put their money in country A from country B, or hedge funds and speculative traders are going to be trying to earn that free overnight carry trade, and they're going to chase the interest until it hits a peak and the central bank stops raising interest rates more than another country, and then they're going to lock in their profits. Or they'll just sit there until one of the central banks either cuts interest rates or raises interest rates. And then if the interest rate difference starts to narrow and that overnight carry starts to deteriorate, the trend reverses. And there you have it. That's what drives currencies. And that explains why the overnight carry trade is the #1 reason why exchange rates are going up or down in value, okay? So what causes the trend? it's not when the central bank raises interest rate, it's the expectations of interest rate increases. Because if you know how to forecast inflation and forecast higher interest rates or lower interest rates, you will be able to know when to buy an exchange rate or sell an exchange rate, because now you understand where the flow of money is going between currencies. Okay, because now you understand where money is flowing. It's wherever interest is higher. Okay. So it's the speed in the direction of interest rates changes which will determine how aggressively a currency will rise or fall in value. And I want to give you a really good example of this actually. You see how the yen lost, how much did the yen lose of its value against the dollar between 2002 and 2022 to 2024. So I just showed you this trend where we saw the dollar go up in value against the yen by 40%. But notice, guys, during this massive trend here, okay, the dollar only went up against the euro by 15%. Why was that? Because Europe's interest rate went all the way up to 4.5%, whilst America was at 5.5%. So if you're a currency trader, where are you going to try to put your money? If you could take the trade where you are looking, for an example, at which currency trade do I want to take in the markets, you're obviously constantly trying to find the currency pair that pays the most amount of interest. Sorry, I'm just trying to get this spreadsheet back up again. I don't know why I keep disappearing so much. Okay, so look, just think about this, guys. Euro, USD. Europe's interest rate went to 4.5%. The dollar's interest rate in America, the US interest rate went to 5.5%. So there's only 1% difference in interest rates. So yes, the dollar did strengthen against the euro in the early parts of the trend. Okay, but then soon as the European central bank started to raise interest rates, now this trade's not very attractive to investors because I'm not getting paid that much interest. It's not a trade I'm excited about. But the USD JPY trade is a trade I'm excited about because the difference pays me a lot of money. Okay, I'm only earning £28,000 a day if I sell the euro to buy the dollar. But if I sell the yen to buy the dollar, and we have this huge difference in interest rates, well then I want to take this trade because I get paid the most amount of interest. I get paid 160 grand a day. That's why the yen lost 40% of its value, and the euro pretty much didn't lose any of its value because as soon as the central bank in Europe started to raise interest rates, the currency pair pretty much didn't go anywhere. Okay, so now you're starting to see investors are chasing the trends where the interest rate differential between two currencies is the widest because that's where you make the most money. Okay, so let's carry on where we left off. And we looked at, for an example, the bond market as the explanation. Okay, insurance companies and pension funds are trying to buy government bonds as their safest way to park their money because they need to pay interest. They need to make sure they can pay out insurance claims. They can pay out on people that need their pension, for an example. So they can't really speculate in the stock markets or on currency moves. They're exchanging money between two countries' currencies because they're trying to put money in the bond market. Okay, and what is a bond? The bond is just an IOU. The government needs to borrow money because they're not raising enough money in taxes to run the economy. It costs more to run the economy than it does in how much tax revenue they're taking in. So they issue debt to investors. You can issue debt between 1 to 12 months or 1 to 30 years. Okay, now this is important because you have bonds that range from 1 month up to 30 years. And again, if interest rates are going up, it increases the demand for this country's government bonds. If interest rates are going down, then it decreases the demand for a country's government bonds. And again, when we looked at the US central bank raising interest rates, the dollar got fucking strong. Okay? Whereas if the central bank is cutting interest rates, as we saw with the US dollar against the yen or the Aussie dollar example against the US dollar, the currency pair will then go down in value because of the interest rate differential. So that was the example there between dollar yen, between the Fed raising rates. And look, again, the euro only lost 15% of its value compared to the dollar, to the yen, sorry, losing 40% of its value. Again, very big difference. Okay, so the key for us is, well, if we know interest rates go up or down, and that drives currencies in the bond market and the overnight carry trade, well, then the question is, well, how do we predict inflation and interest rates? Because once you do that, you catch the trends with the hedge funds. And we do this by using something called leading economic indicators. Leading economic indicators is how you predict where interest rates are going. Now, this is the professional way of trading currencies. Notice, guys, we're not looking at charts. We're not looking at chart patterns. We're not trying to gamble on price movement. We need to understand, when is a central bank going to raise interest rates, or when is a central bank going to lower interest rates? And it's all down to one thing: inflation. So we need to be able to measure inflation, because if we can measure inflation, we're going to be able to catch the trends with the professionals. Okay, so when we're investing, there are three types of economic data. Okay, and investors are looking at economic data as a roadmap to help them measure the strength of a country's economy, and most importantly, what's happening with inflation. Is the economy going through inflation, so there's economic growth, or is the country going through deflation, so there's an economic contraction? And the central bank is going to respond to the expectations of inflation by increasing or lowering interest rates to control inflation and help make sure there's maximum employment and economic growth. And as you've now seen, that's going to drive the currency markets. So for us as traders, we are interested in leading economic indicators that predict the future. We're not interested in coincident economic indicators, because that is data that tells us what's happening in the economy now, but it doesn't tell us what's happening in the economy in 6 to 12 months. And lagging economic indicators is backwards looking data, which doesn't tell us anything. This is like GDP data that comes out once every 3 months, and it's telling you what happened for the last 3 months. That's not telling me where inflation is going in the future. So we're not interested mainly in this economic data. We can pay attention to the coincident economic indicators, but it's just literally last month's data, like inflation, for an example, or employment. We're trying to predict where inflation is going, so we know where interest rates are going. So to be able to understand this flow chart, leading indicators predict what's going to show up in the coincident economic indicators in the next 12 to 18 months. And this is what governments need to achieve to stay in power. You need to be able to say to people, look, vote for us again. We had maximum employment, the economy is growing, the stock markets are rising, your pensions are going up in value, we're doing a good job, please vote us back in, right? That's how they get into power. And the central bank and the government are constantly monitoring the leading economic indicators, predicting what's going to show up in the coincident economic indicators, and they react to this data to ensure that this data gets to their target in the next 12 to 18 months. Remember, interest rates take their time to work their way through the economy. As the interest rates go up, it takes time for you to really notice the interest payments that you're now having to pay going up, and then it calls you to slowly cut back on spending. It's not instant. So central banks need to steer the economy towards their targets. They can't be reacting to what's happening with inflation today, because interest rates take their time to work their way through and inflation may get out of control. So this economic data predicts this economic data, and the central bank's interest rate, along with some government policies, are being implemented today based on this. So if we can understand where these economic indicators are predicting the economy is going, we can predict interest rates. And that's the flow chart. Many traders don't understand this, and they try to trade inflation data, employment data, not realizing that this doesn't predict anything. This is just last month's data. When you get monthly inflation, it's telling you, if we're in April now and inflation comes out, it's telling you inflation for March. That doesn't predict anything. Okay, so stay away from this data. Okay, and you need to move to the professional side of the markets, which is predicting, not reacting. Okay, so leading economic indicators are used by central banks, governments, and professional traders to predict the future performance of the economy and forecast what's going to happen over the next 12 months. Leading economic indicators are the main source of data we must pay attention to understand the direction of growth and inflation. Because if we can understand where growth and inflation is going, you know what the central bank is going to do in response to direct the economy to their targets. So we use two key data points: business surveys and consumer surveys, the two most powerful economic indicators that professional traders are using to predict and understand exactly where inflation is going to be going in the economy. Okay? So again, remember, leading indicators predict. Coincident economic indicators just tell us what's happening now. Okay? And lagging economic indicators is more to do with the reaction by central banks and governments, okay, in response to the leading economic indicators. So we need to predict. If you can predict the economy, you can predict inflation, you can predict where interest rates are going. And I'll show you where you can see actually every single month where the markets predict the central bank to take interest rates, and you'll get into the right trades. So we need to build this view. Are we expecting inflation? And then are we expecting higher interest rates? And if that is the case, we know the currency gets stronger. Or are we predicting with our leading economic indicators deflation? And if that is the case, sorry, this is a typo. It's meant to say lower interest rate expectations. And if we're predicting deflation, we know we're predicting lower interest rate expectations, again, which is going to weaken the currency. Higher interest rates attract the overnight carry trade investors to buy that country's currency. It attracts investors in the bond market to buy that country's currency and park their money in government bonds. However, if there's deflation, investors don't want to be holding these assets because the lower interest payments makes the country's currency and bonds less attractive. Okay, so it's clear that when we're trying to predict what's going to happen in the economy, we need to hear from businesses themselves. And they release two really important surveys: the Manufacturing Purchasing Managers Survey and the Non-Manufacturing Purchasing Managers Survey. And this is very fucking important because you only got two types of businesses inside of an economy. A country's is filled with businesses that manufacture goods or provide services. Okay, now how we do this. This spreadsheet is going to show us how we start to measure a country's economy. And what we're always trying to do is predict where the economy is going. So we're going to build a scorecard system. And the scorecard system is basically going to score the key economic data points which start to predict where the economy is going inside of a country. So we're going to start off by looking at the manufacturing sector. Okay, the manufacturing sector is very important because manufacturing makes up 20% of businesses. Okay, what is a manufacturing company? A company that manufactures cars, it manufactures airplanes, it manufactures computers, whatever. Okay, and a services-based business, which actually makes up, well, it was 80%, it's actually 85% of businesses in America now. So these two surveys are very, very important to understanding what businesses are telling you. And these surveys basically ask the purchasing managers a bunch of questions from the biggest companies in America. And the question is basically, what are your expectations for corporate earnings? Are you expecting your earnings to increase or decrease? Are you expecting to employ more people or sack more people? Okay, and why would managers at the biggest companies in a country be telling you in their surveys what they're predicting? Because they're getting orders in real time from consumers. So they are the first people to understand what is the consumer likely to do. Spend money, create inflation, or cut back on money, create deflation. And this is why central banks are using business surveys to really predict where the manufacturing or the services sector is going. Okay, now this data is so accurate. It predicts inflation and GDP with an 85% certainty going back to 1948. Okay, so on our scorecard and system, the first thing we are going to be looking at over here, okay, is again the manufacturing report. So when we're looking at the manufacturing report, what we are trying to identify when we're looking at this report is, again, is this report telling us that the manufacturing sector is going through growth, or is it going through contraction? And I want to show you over here, when we look at this report in more detail, just how accurate this report is. So highlighted in blue is the manufacturing report, and highlighted in red is GDP growth on a quarterly basis. So look what happens. Notice when the blue line is above the score of 50, this indicates there's growth in the manufacturing sector, and we see positive prints of GDP. If the economy is growing, that means there's inflation. If we look at the blue line, when it goes negative, we then see GDP growth turning negative. This is when there is a cutback in spending for consumers. Okay, so this report in the blue line, if it's above 50, it means there's growth in manufacturing, there's spending, there's inflation. If it's beneath 50 and contracting, then there's deflation and there's expectations of a cutback in spending. Okay, so this report shows you the correlation between the manufacturing surveys telling you if there's going to be growth in the economy or not, and then actual data showing you the level of growth inside the economy. Okay, so this is like quarterly GDP. So is the economy growing at 1%, 2%? If it's growing at 1%, 2%, 3%, there's higher growth, there's higher inflation. If economic growth is slowing, so growth goes from 3%, 2%, 1%, maybe even negative, well, what's happening? Consumers are cutting back on spending. Okay, and this survey is telling you the expectations of growth, and it predicts growth of an 85% certainty. So this economic data is fucking gold to investors. So what we do, we come over and we use our scorecard and we say, okay, what's the latest score for an example, manufacturing? So if we come over here and I look at the latest score in America, it's at 49. Okay, that means manufacturing is in a negative score. So I give that a negative score of 1, which means that is deflationary. Okay, so we understand what the manufacturing sector is telling us about the US economy. Now we have to pivot and say, okay, we understand what the manufacturing sector is telling us, but now, let me just take off some of these spreadsheets. Now, let's take a look and see what is the services sector predicting. And why is this important? Because the services sector makes up 85% of businesses. So this report does exactly the same thing. It asks companies that are producing services the same series of questions. What are you predicting for the economy moving forward? Are you predicting growth in your earnings, contraction in your earnings? And that's always been driven by consumer spending. So we analyze the services PMI, again, in exactly the same way. We look at the monthly report and we see, is the report either above 50 and growing or beneath 50 and contracting? And this is telling you if the services sector is in growth territory or contraction territory. And if we can look at the manufacturing and the services data together, now you have 100% of businesses telling you in real time, we are predicting growth in our earnings, which is inflationary, because you can only increase your earnings if consumers are spending, okay, which creates inflation. Or if they're telling you we're expecting our earnings to contract, well, you already know what that means. Consumers, for whatever reason, are cutting back on spending, which will be deflationary, okay? And that is a negative sign for the economy. So remember, an inflationary environment, central banks are likely, if inflation is out of control, to raise interest rates. In a deflationary environment, they're likely to cut interest rates. Okay, so if we look again at the latest data, the services sector in America right now today is in growth territory. So we give that a score of 1. Okay, so we've got a negative score for manufacturing and a positive score for the services PMI. Okay, so we tick off these 2 key indicators. Then we need to look at consumer surveys, because what makes up inflation? Consumer spending. So if we can look at the confidence of consumers, we can get an early indication if they're expecting their economic prospects to be better in the future or worse in the future, and that's going to affect their spending habits. And that's directly going to affect inflation and is going to directly affect what the central bank does with interest rates. Okay, consumer spending makes up 60% of the US economy. Okay, and the government spending makes up the rest. So this is vitally important. If consumers are confident about the future, they spend money. the stock market goes up, the economy grows, and there's inflation. If they lose confidence, they cut back on spending, the stock market goes down, there's deflation in the economy. That's the environment where we would start to expect maybe the central bank to cut interest rates. Okay, so again, this is a very, very important survey. Okay, so what do? We come back over to this data, this key data, which the markets are paying very, very close attention to. I want to show you just how accurate this data can be. So notice when consumer confidence is above the score of 80 or higher, look, you've got positive levels of GDP growth, inflationary. If consumer confidence, highlighted in blue, starts to deteriorate, okay, there's certain levels that match up to certain levels of growth. Look what happens. GDP turns negative. I've even got an example here of the European one, which just shows you how beautiful this is. Look at this. Consumer confidence is high, and then it starts to go lower. Consumers are losing confidence. Look what happens. GDP starts to decline because consumer confidence drives spending. And then look, if consumers start to get more positive, look at the blue line going higher. No surprise, the GDP data starts to get positive. So look how much consumer confidence drives quarterly GDP, which is what? The total value of the economy. So if we can predict consumer confidence, we already know that's going to affect their spending and that's going to affect inflation. So what we do is we read the latest numbers of the consumer confidence report, and we give it a score towards what level of inflation is it showing. At the moment, because of Trump and his tariffs, consumer confidence in America plunged to 60. This is indicating minus 2.2% GDP growth. That's not good. That's not positive. Okay, so what do? We give that a score of -1. Okay, so remember, we're building this view of the United States, okay, to give us our bias as to whether we are expecting inflation or deflation. Okay. Next up, we have consumer confidence surveys. Okay, and this goes in hand with that same economic report I just showed you with the UMSCI. So when the report comes up, you basically have to go into the report and read what is the levels of consumer confidence and expectations, because that is very, very crucial to the data. And if I show you over here on this spreadsheet, you can see that when we look at the consumer confidence surveys, it literally predicts the expectations of consumer confidence. So here's the expectations versus the actual data. Notice that this line, the orange line, is the consumer confidence, and the purple line is the expectations. Notice how the purple line moves before the orange line. So the expectations of consumers about the future of inflation is driving their confidence. This is why central banks have a very important piece of data they follow, which you're going to come onto very, very shortly, called inflation expectations by consumers, okay? Because this is going to drive their spending. So we've looked at manufacturing, services, consumer confidence, 3 of the key economic data releases. Remember, we're just building out this view of where the economy is going. Then we monitor consumer inflation expectations. This is crucial. Every month they release a report which asks consumers, what are your expectations about the future? Where do you see inflation in the next 1 year, 3 years, 5 years? And this is crucial, because if inflation expectations go out of control, consumers may lose confidence, which is why central banks monitor this very carefully, because they need to predict where consumers are expecting inflation to go to make sure that they can control their expectations so they have confidence about the future and they can spend money. If consumers expect inflation to rise rapidly, they may get afraid about the future, they may cut back on spending, or they may even quickly rush to buy items before they go up in value, which is exactly what's happening now in America with Trump's tariffs, and that can cause inflation even more because prices spike because of the demand in spending. Or on the flip side, if consumers are expecting inflation to go lower and go beneath 2%, they may hold back on buying stuff because they may think price is going to go lower even more and I can get a better bargain, but that can cause deflation and economic contraction. So when the survey comes out, we have to monitor very carefully what are the consumers expecting for inflation. So here you see it. The latest reports as of April, and this is being caused by Donald Trump, inflation expectations in 1 month on his tariffs have jumped to 6.7%. 5-year have jumped from 3.9 to 4.4. Again, consumers are telling investors, we're expecting higher inflation. The central bank doesn't like it. Okay, so they're going to watch this very closely to make sure that their inflation expectations are anchored around 2%. The central bank wants to avoid the consumer getting inflation expectations above their target, because what they're going to do, if you expect inflation to rise, you may go to your employer and say, listen, inflation's rising. I can't afford to pay for my lifestyle because I need more money. So if you don't pay me more money, I'm going to go work somewhere else. And what will that cause? Consumers to start to demand higher wages. If consumers start to demand higher wages, employers have to pay higher wages, and they then have to raise prices to offset the cost of paying more wages. And this is called a wage price spiral. And Federal Reserve and central banks don't want this. So whenever inflation expectations go above the central bank's target, the central bank is likely to start to raise interest rates to control that inflation expectations. They don't want it to become anchored outside their bound of 2%, which is their inflation target. If they see inflation expectations go beneath 2%, they don't want people to cut back on spending because they believe they're going to get a better bargain and cause an economic contraction. They're going to cut interest rates to get people to start spending again, because now their interest payments go down, their confidence comes back because they've got more money to spend. And this is how the central bank is watching consumer inflation expectations to make sure inflation stays around their target, so people spend, so there's high employment, so there's economic growth. Okay, so again, we come along here and we have a look. All right, so what are the expectations for inflation? Currently, it's going above 2%. So we give that a score over here of 1. Okay, we're going to mind out these two surveys for now. These are new surveys I've just added in, but I want to keep it very simple for now. So we've gone past, at this moment in time, we have looked at now manufacturing, services, consumer confidence, and consumer inflation expectations. Remember, we're just building this view. Is this score beneath 0? So when we're adding up the scores, what we're trying to do is we're just trying to get to a point to say, is the score inflationary or deflationary, for an example? So when I was doing this last year, the score came up to 7. This was an inflationary score, okay? And I'll show you how this helps us build out our view of what to do when we're taking trades. Okay, but let's just carry on the economic data. Then we move on to central bank surveys, where they again go out and ask consumers, what are you expecting for inflation? So the New York Fed does exactly the same as the UMSCI, and they go out and they produce a survey to ask people what they're expecting inflation to be. And why would they do that? For exactly the same reason why I just explained. Central banks need to ensure that you believe inflation will remain around their target, because they don't want you to demand higher wages. They don't want you to cut back on spending if you believe inflation is going to fall. They need to understand where your views are on inflation, because it drives consumer behavior and spending. And you need spending to grow an economy. You need spending to get inflation around 2%. So again, we monitor the New York Fed's inflation expectations over 1 year, 3 year, 5 year. You'll constantly hear central banks talking about this key data, inflation expectations. So we have to monitor it. Okay, so we watch the consumer inflation expectations, okay, and we watch the central banks inflation expectations over here, and we come to a score of, is it together above, is there inflationary expectations or deflationary expectations? And we can see the consumer inflation expectations are above 1. Okay, so now we have to move on to the next economic data, okay, which is the bond market and the yield curve. This is very interesting, okay? Remember I showed you how the 10-year government bond was driving the exchange rates for dollar yen, Aussie dollar, US dollar. But what we need to understand is that the yield curve is basically an expectation of inflation, okay? When you borrow money to a government, you can borrow money to the government over long periods of time. 3 months, 6 months, 1 year, 2 year, 5 year, 10 year, 30 years. Now, longer term bonds pay higher amounts of interest than shorter term bonds. Because if you're an investor and you're borrowing money to the government in America for 10 years or 30 years, No one knows where inflation is going to be in 10 or 30 years. So you want to be receiving a higher amount of interest for the unknown level of inflation. So if you look at the yield curve and interest rates on longer term bonds are paying more interest than interest rates on shorter term bonds, that's a positive sign. That's telling you the markets are expecting inflation. And when you expect inflation, that means there's economic growth expectations. Okay? So when you see the yield curve paying higher interest on longer term bonds, that's a good sign. And the easiest way to quickly see the difference between short-term bonds and long-term bonds is to look at the spread between a 2-year government bond and a 10-year government bond. If the number is above zero, that means all you do is you take the 10-year interest rate on a government bond and you subtract the 2-year interest rate. Anything above zero basically means investors are demanding a higher interest rate to buy 10-year government bonds than the 2-year government bond. So that's a guaranteed market expectation of inflation. If the interest rate difference starts to narrow and come towards zero, well, then that is because the markets are expecting for some reason the economy to slow down, so inflation to becoming lower. What would the central bank do if they're expecting lower inflation? Cut interest rates. In this environment, where they're expecting inflation, we have a bias towards potentially higher interest rates. If it's beneath zero and contracting, meaning that 10-year government bond interest rates are beneath 2-year government bond interest rates, this is when the markets are predicting a recession. You're going to get steep interest rate cuts by a central bank. So we're trying to sell the currency aggressively. Okay, so again, we come over to our spreadsheet and all we do is we're saying, okay, where is the yield curve? Okay, at this current time, and we have the data here. This is the difference between a 10-year government bond and a 2-year government bond. It's above zero. So we're in an inflationary environment. So we put a score of 1 here on our scorecard. So let's move over to the next economic data point, break-even inflation rates. This is the market's actual level of inflation being predicted over 1 to 10 years, which is crucial because the market's expectations for inflation is obviously going to be watched very closely by the central bank, and they're going to have their predictions, and the markets get this very accurately right, okay, because this is economists at investment banks, hedge funds, seasoned economists are pricing their expectations. So what do? We come back over to the spreadsheet, okay, and we're looking over here. Inflation expectations. We can see 1-year inflation expectations are around 2%. That's good. 2-year around 2.86%. 10-year expectations around 2.38%. Perfect. We're expecting inflation, so we're in a growth territory in America. Okay, inflation is in the positive. Okay, so that's a good sign. So when we look at the market's inflation expectations, we give that a score of 1 as well. Now we move on to the next economic data point, which is implied interest rates. Now this is key. Remember how I was telling you about the overnight carry trade? Well, if you can see meeting by meeting where the markets are predicting the central bank to take their interest rates, well, you know exactly where an exchange rate is going to go between two countries' currencies. Okay, so what we do is we look at implied interest rates by getting the contracts of the markets expecting where interest rates are going to be going each and every month, and we can start to build our view as to where the carry trade is likely to go. So over here, when we get this data up, this is probably the most important part of our strategy. We need to know exactly where the markets are predicting interest rates to go. So over here, we have implied interest rates. So for an example right now, we have the Federal Reserve's interest rate of 4.5%. But as it currently stands, the markets are predicting by the end of the year, interest rates in America to go to 3.5%. So we're betting on interest rate cuts, okay? Now, if we was to compare the US central bank's interest rate expectations to, let's say, the Bank of Japan's interest rate expectations, notice how the markets are betting that the Japanese central bank is going to go from 0.5% to the end of this year going up to 0.85% to 1%, okay? So interest rate expectations in Japan are going up, but interest rate expectations in America are going down. So what do you think the carry trade investors are going to be doing? So if you're seeing rates in America right now paying 4.5%, and in Japan they're paying 0.5%, but you're expecting rates in America to go down to 3.5%. So if you was selling the yen to buy the dollar, yes, you would be making 115K a day if you're a hedge fund trading that lot size. But look what happens as the interest rate differential narrows, that goes down rapidly. Okay, so currently investors are betting the Fed to cut rates, and now you start to see why UBS are cutting the dollar's outlook. This is literally just the other day, yesterday. This investment bank's cutting the outlook for the US dollar. The yen extends gains beneath 140 on a psychological level. Dollar resumes losses as traders seen clinging to bearish bets on the dollar. Speculative traders boost yen bullish bets to records on tariffs. Okay, so at this moment in time, we are starting to see that investors are betting on a stronger yen. Okay, they are betting on a stronger yen. Why? And why is this playing out in real time? Why is the yen getting stronger against the dollar? Well, now you see. Because the markets, the reason the yen is already has gone up around 11% against the dollar in 2025 is because the markets are betting on rate cuts in America and interest rate increases in Japan. So the implied rates tells us exactly the level of interest these two currencies are going to be going to. So over here, we can literally type in the current interest rate in America and Japan, and then we can go to the expected interest rate in America and Japan. And now we can see the difference goes from 4% in America's favor to 2.5%. So what does that mean? Investors who maybe were buying dollars are no longer buying dollars. And the more that the markets predict the yen to get stronger against the dollar, well, now you understand why they are betting on the yen to extend gains past 140. Interest rate differentials. Okay, guys, this is key. This is why we have to track the data to know where interest rates are going. You see how we've started to build our view on the United States? Okay, notice we didn't look at charts. We had to go through this whole analysis of looking at the overnight carry trade, where are interest rates going, where would be the interest rate differential moving in favor the most for one currency against another currency. And right now, the markets are betting on interest rate cuts, mainly because of the tariffs being imposed by Trump. Okay, so now we've looked at implied interest rates. Again, giving the markets the view that they should be selling the US dollar. Okay, so let's get back up our spreadsheet. And if we look at implied interest rates, we're betting on rate cuts. That's not positive for the dollar. Okay, now, next up, we've understood where interest rates are going. We're building out this scorecard. We're building out this view of the United States. Okay, and remember what I showed you over here. You see when I was showing you about the 10-year government bond yield in America driving the currency markets? Well, just remember when the Federal Reserve was raising or lowering interest rates, this is what was driving the 10-year government bond interest rate up or down. This interest rate on a 10-year government bond, which is causing the trillions of dollars to flow between the bond market, is always being driven by interest rate expectations, okay, by a central bank, which is why implied interest rates, this spreadsheet here, is your golden ticket to being able to anticipate where exchange rates are going next. Okay, so it's very, very crucial. So we're building this scorecard and we're building our view on where interest rates are likely to go, because we understand the economic data that not just professional traders are using, the central banks are using to adjust interest rates. Now we can go and look at the central bank's actual forecast to predict what is the central bank seeing, because the central bank is going to cut interest rates for a reason if the markets are expecting it. So in the latest forecast by the Federal Reserve, released in March, notice how their expectations for growth is changing. Okay. In December, they was expecting growth to be 2.1%. They've now cut their growth forecast down to 1.7%. Next year was 2%. They're cutting it to 1.8%. 1.9, 1.8, 1.9, 1.8. So we're expecting growth in the economy to slow. Okay, right? So this is a problem for the United States. If you've got a slowing economy, what does the central bank have to do? They have to lower interest rates to make sure the economy keeps growing. What they also expecting for the unemployment rate to rise, 3.4 to 4.4, okay, in the next year. This isn't good, okay? And the central bank themselves, the central bank is telling you in their own forecast, when you're looking at the bank rate right now in America is currently 4.5%, and the central bank's telling you in their latest forecast it's going to go down this year, down next year, down the year after that, and down the year after that. So the central bank's forecast is confirming to you what the markets are predicting with their own interest rate implied rates that we looked at in the spreadsheet. So if we come over again to the spreadsheet, we can now plug in our numbers. Okay, we're now building this view. Central bank forecast, there's growth in the economy, but the key is this, rate cuts. Okay, because again, guys, what drives the value of a currency? Interest rates. That's all we need to remember. Okay, so that's how the forecast look when the central bank releases it. It will have the latest one at the top line compared to the last reading, their last forecast released in December. So now we can see what's going on. We're looking at, for an example, the central bank's forecast. We're building our view. We're having a look. And at this moment in time, the markets are betting on the weaker US dollar and a stronger Japanese yen, for an example, because of interest rate differentials. Now, the next key step before I take a trade, I want to see what the professional markets are betting on. So there's something called the COT report. Now, this is absolute gold for us as traders. We can see in real time how many contracts in the futures markets are being bought to buy the Japanese yen or sell the Japanese yen against the US dollar. So this is called the flip number. Now, when the number is above 0, this means there's more contracts open to buy the yen against the dollar. If the flip number is beneath 0 and minus, that means there's more short contracts to sell the currency against the US dollar than long contracts. So basically, just taking the total amount of contracts to buy a currency, total amount of contracts to sell a currency, and it's coming to the difference. And the difference is either positive for the yen or negative to the yen. And look where we stand right now. And this comes out every week, and you can see where hedge funds are putting their money. They've gone from being negative the yen. Look, we can see all last year negative the yen, and they flip now to being positive. So you can see with the COT report, all right, so if I want to sell USD JPY, well, the hedge fund community is actually now aligning with my view for me to get into the trade, okay? And then once we come to taking a trade, now all we got to do is use risk management. How much of my account do I place on a trade? Where do I place my stop loss? Okay, I got a whole risk management video on YouTube for you guys to watch. It's fucking powerful, and it'll make sure that your accounts are protected before you get into a trade. Okay, so if we was to look at this in isolation, the markets are betting on rate cuts. We would, before we took the trade, we would obviously do exactly the same analysis when looking at Japan and just go through the same amount of economic data, and it would get you to your answer as to why the markets are expecting interest rate increases in Japan and decreases in America. Okay, so here you get it, guys. We're now building this scorecard. We're building our view of inflation. So we use the economic data to bet on where inflation is going. And if we have an inflationary or deflationary score for our country's economy to help us get to our answer. Do we buy a currency or do we sell a currency? So at the moment, yes, the US economy isn't a growth territory, but growth is slowing, okay, because of Trump's cuts. We've got negative consumer. The manufacturing data is not great. The services data is just above 50. Consumers are losing confidence, okay? As you can see, because of the inflation expectations, the markets are betting on inflation to be around the central bank's 2% target. And because of Trump's tariffs, the markets are betting on rate cuts because the central bank is going to have to save the economy from these rate cuts, slowing economic growth. And this is how we take our currency trades. We're not gambling on price movements. We're not making up these trades based on chart patterns. It's all based on fundamentals. Now, obviously, I've just skimmed through it very softly for you guys, but on the education where I mentor people, I go into depth about how to really read these, how to build the scorecard in a more systematic way. It will take me hours to go through it with you guys, but I just wanted to show you what it takes to take trades. I want you to listen to Connor, who took this education and look at the results for himself when he joined my mentoring community. And just look what happened. He started with only £250.
Hello guys, my name is Connor, and as you might have seen from some of the screenshots that Kyan has shared, I've made over £10,000 now trading with Kyan. I started in January, so in just 3 months I've made £10,000 following Kyan's signals, following his advice, following his trading education. And like a lot of you, maybe you have an interest in Forex, you have an interest in trading, as I did. I wanted to join Kyan's VIP for a while last year, and I finally made the choice to do it in January, and it's been amazing. So I'm really grateful to Kyan. Thank you, brother, for teaching me, for showing me why the markets are changing, giving me advice and trying to push me to understand the markets more and be a better trader. And I really want to continue this journey more. And I just say to anyone out there thinking of joining us in the VIP, it's worth it. If you just follow his signals, follow his advice, you will make profits, as I have done. So yeah, thanks Kyan, and hopefully see a lot of you in the VIP.
So that was Connor, £250 into £10,000. Again, just following the same system that I've just shown you. Okay, so the results obviously for what I'm teaching really does work. I want to also show you how I helped another guy who took my education. Is listen to what he said. He started off doing exactly what most people do, technical analysis. But let's take a look at the results. Was you trading before you joined me?
Not properly. Done little research on trend patterns and all them kinds of things, and sometimes it worked, sometimes it didn't, and more time you're just frustrated, isn't it? Because you're not understanding why things are moving the way they're moving and all them things. So definitely doing the course has helped me with that.
How much did you say you made in total so far?
I think I've cashed out probably close to
£12,000. That's not bad, man. And how much did you invest when you started?
I'd say probably £1,000.
That's like a 12 to 1 risk to reward there.
Yeah, for sure, for sure.
And we're only getting started, man. Next year's going to be even better for us. So, and if there's anyone who's watching this, what would you tell them in terms of after you finish the course and they're thinking maybe about joining or taking one of the educational courses that we provide?
Yeah, I'd say definitely get the education, get the fundamentals and all that information of why things in the stock markets move, in the Forex, crypto, all of that. Otherwise, you're just doing it blind. So yeah, definitely I would recommend it.
So yeah, that was Benjamin. So that was Benjamin, £1,000 into £12,000. Again, inspiring results. One more testimonial I want to show you from this guy. This is incredible how much he made. And his results were phenomenal.
Guys, this is Rakib. Just a quick testimonial video. I've been in Kyan's group for over a year now. I did start off with £300 and have turned this amount into over £50,000 in less than 2 months just by following Kyan's signals on the educational side of things with the other members as well. So if you haven't already joined, guys, I would highly recommend that you join and don't miss out on the next market move.
So again, that was Rakib. Obviously, I'm not saying you're going to turn 200 or how much, 300 into 50,000. That was an extreme level. We had a winning streak of trades, and obviously he was risking quite a lot, which is what I don't advise, but that just shows you could turn £300 into 50,000. So if you're thinking about trading currencies, the number one thing is, if someone's not giving you this education and they're telling you to follow chart patterns, I want you to run for the hills, because you're going to be in the same boat as all the other retail traders, failing, constantly learning the wrong information. But if you want to get the same results as these members using the same macroeconomic data as I've been showing you in this video, so you can start to trade with the hedge funds with all the headlines I showed you, this is the education you guys need. It will give you guaranteed results. Okay, you can try to go and figure this out for yourself, but it'll take you a long time and a lot of failure and painful lessons, because it's great to have someone like me mentor you. I've been there, I've done it, I've helped so many people, and I would love to help you guys too. All right, so guys, thank you so much for watching. Please get in contact. There's a link beneath if you want to book in a call, okay, and start your journey on investing into Forex. And I hope this video really did add some value and opened your mind to fundamentally what drives the value of currency, which is interest rates.